Good morning and welcome to Money Control. Well, the market has started on a very cheerful note on the back of 8 years of positive returns in 2023. As we approach 2024, it is almost like, everything looks positive. The general outcome of the general elections mid of this year in May seems to be a foregone conclusion. The fact that the Fed will cut interest rates mid of this year, that also seems to be a foregone conclusion. So the market is obviously counting on a number of positives. Earnings trajectory also likely to moderate, but nevertheless going to be pretty strong this year too. That's the expectation on the street, but what can we really count on? What could be the fresh triggers for stocks to go up, and what are the headwinds or risks that we should be watchful about? To talk about all this and more, we have Neelkanth Mishra, Chief Economist at Axis Bank and Head of Global Research at Axis Capital. Neelkanth, thank you so much for joining me on this discussion today. Neelkanth, you have been bang on post-pandemic in terms of your projections, and absolutely nobody, not the government of India, not the RBI, has got it this right. How were you so bullish all through?
No, thank you for first registering that, and thank you for flagging it as well. I think the main reason was that during COVID and as the recession was underway, we were doing a lot of deep dives. There was a lot of intense work about just trying to understand where the economy was, which parts were getting badly affected, and then trying to model who was bearing the losses. And we discovered two things. First, that this recession was very different from any recession that we have seen in the past. Mostly recessions happen when there are excesses that build into an economy. So for example, a real estate bubble or a capex bubble or a financial system distress. In this one, you just ask people to stay at home for 6 months or 9 months, and then you ask them to come back. And so given that this was not because of any structural problems, we realized that the rebound from it would be much better than most people expected. And I think the second one was the allocation of losses. See, it was well understood that emerging markets like India could not have delivered the kind of fiscal stimulus that some of the developed economies did. And therefore, how much of scarring has actually happened? How much of economic wealth, how much of productive capital has been destroyed? So as we started allocating, so we went in the innards of the data disclosed by the Central Statistical Office, and it's quite remarkable how much data they actually disclosed. And as we started allocating the revenues and losses, we realized that 55-60% of the economic loss, the loss of GDP during the pandemic, was actually being borne by the government. And when that happens, that the damage on the rest of the economy in terms of balance sheets is not that extreme, and that therefore the rebound can be quite healthy. While when you're forecasting, you're kind of batting like Rishabh Pant, you can't bat really like Rahul Dravid. So you get some, you lose some. But on this one, I think the fact that we have gone through these frameworks helped us get our forecast right.
Sure. Neelkanth, last quarter, obviously the surprise was the largest. If you look at the last few quarters, last quarter surprise was really the largest. Were you also surprised last quarter? And what do you see were the triggers then? And what could be the triggers in the next 2 quarters? And what's your prognosis for the next fiscal?
So, late in 2021, we had done a deep dive on the real estate market in India. And I was very curious that, if the number of households is growing at 2.4% a year, the average size of a house is growing at 4% a year, the quality of construction continues to improve, why is it that cement volumes aren't stronger? Why is it that construction of real estate in India is not stronger than it is, and that it had been going through a 10-year downturn? And then we flagged that, looks like the real estate cycle, which was supposed to have started turning in 2016, but then, demonetization era happened 2018, and then IL&FS went under, then 2020, and then COVID happened. So that after 6 years, finally a recovery seems to be underway. But I've been surprised by the pace at which that recovery is showing up in terms of not just the the developer built real estate, because that's something that we in the markets can track, because we of course are interacting with the larger developers. But what has been surprising is that the independent home builder, in India, most of the housing is actually stuff that people build either themselves or they hire a small contractor to do it, right? So it's ground and ground plus one. And so the demand from the independent home builders also started picking up. And that was I think, where even we were surprised. We were expecting a real estate market recovery. The fact that that market had started kicking in as well was surprising. And the second thing has been just the response that we have seen in the industry. That the moment, and in hindsight, this seems intuitive that it was bound to happen, but it was hard to anticipate that most companies were, I think, anticipating that growth was going to be, say, 6% or 5.5% post-pandemic, and they thought they had enough capacity. But as they found, like cement companies found that if there's going to be 10%, 12% volume growth, then perhaps we don't have enough capacity and we have to start planning for it immediately. And the moment you start, one company starts doing that, every company starts doing that. And the fact that now they are starting to do CapEx itself triggers more optimism, and therefore that's how CapEx cycles build up. And so the timing of when this started to build up is another thing that actually has been very surprising, but in a very happy way.
Sure. So on real estate itself, at least when you look at the public markets, even otherwise, it's only the luxury segment that seems to have seen a lot of volume growth, right? How do you see that? I mean, will we be able to, because in affordable housing, most realtors are saying that there is still demand is not anything to talk about. Do you see this extending into the affordable housing segment as well? And will we sort of hit a ceiling in terms of luxury demand anytime soon?
Okay,
so I'm just saying this whole rally around real estate. I'm not only talking about the stock market point of view, but in terms of overall volume and growth, the brisk pace that we have seen in the last 1 or 2 years. Do you expect that to continue at all?
Yeah, so there's several questions embedded in there, right? So the first is the pace of construction. Remember that real estate prices going up is a wash for GDP. I mean, while it may be exciting for the developers or people who hold a lot of real estate, for economists like me, I think it's a wash because it doesn't show up in GDP. The second question is the mix. I mean, is it that the luxury segment is doing very well, affordable segment is not? And the third is that is there again a price to income ratio and all that. So the first point is dwelling construction as a percentage of GDP. The value of output of construction was 16.6% of GDP in 2012. It had fallen to 10.5% by 2021. It has now started to rebound. I won't be surprised if this was 13 or 14% of GDP sometime in the next 2 to 3 years, maybe 4 years. And the reason is that now inventory levels are very low. There are developers in Bangalore with 2 months of inventory. There are developers in Gurgaon, very famously, they're not throwing ads, that they sold a complex with, maybe not even a brick laid, where there is, in 3 days they sold it off completely. So now they need to build, and when they start building, it will add to GDP. So I think that the economic impact of real estate construction is yet to show up fully, and that's why I think we should be positive from a GDP perspective or demand for cement and labor and all. The second aspect is there a problem at the lower end, and is this only a upper end segment? You see, we also did a deep dive just 2 days back. We published it. We've been thinking about it for a while as to why is it that despite 7% GDP growth, the consumption, some of the consumption indicators are not looking that good. So there are a few factors there. The first is that there is still slack in the labor market. So despite the fact that our recovery has been far better than most people expected, we are still about 1.2 years behind where we would have been if COVID had not happened. And we are catching up, so we are now growing faster now than we did pre-COVID. in the just few years before COVID, and therefore we are catching up. But there's still some slack in the labor market because the number of workers who came in the last 3-4 years has not changed because people of certain working age, people joining the workforce, those numbers. So the top 20%, which accounts for 75% of total savings in the country, and on average have more than 40% of their income saved because the savings rates are very high. Their consumption or their appetite for investment or whatever does not change very quickly. And therefore, what you are seeing is that the demand for real estate, because the price to income ratios have changed quite nicely, and then they can afford these. So therefore, I think the upper end demand is the first to rebound. The middle income levels, this is in the next 30%, which at the upper end of that would be the affordable housing that you and I can track through companies. That segment still hasn't seen pricing power and wages, and until they get that, I think the surpluses they can generate are not strong enough. And the bottom 50 is actually not going to show up in any of the metrics that you and I look at, other than, say, in consumer staples demand or pharma demand or telecom demand. And they're also starting to improve. So we are starting to see an improvement there. But again, I think the pricing power for labor is not strong enough. But in aggregate, I must say that when you think about cement volumes growing in double digits, so December was a bit weak, but we think it's an aberration because of disruption. If you have cement volumes growing, which means that all types of houses are being built, and it's not just developer built real estate, but the independent home builders as well. And the third question, which is, are we now hitting a ceiling? I mean, is this the best we can see? I think this is too early for that, because real estate cycles, when they do turn, they tend to there is a certain playbook which can play out, in the sense that if companies are now running out of inventory, the next thing that happens is that prices start going up. And when prices start going up, then that actually brings forward demand. And people who may have said, oh, you know what, I can't afford this house right now, I'll buy it 2 years later. And then someone says, 2 years later, it's going to be 20% more expensive. So then they start buying it immediately. This is a classic economic cycle. And so we are now starting to enter that phase now. We need to be very careful. As policymakers, I think we need to think about how we can keep the real estate upturn a volume-driven upturn instead of a price-driven upturn. So we need to unlock supply, reduce bottlenecks and all that, so that the volume-driven phase remains for longer. But I don't think we are going to peak out, say, in the next year or so. Maybe I think it's going to take longer than that. Okay,
a question around that. So you said, real estate cycles tend to be longer, which I agree. But the fact that, when you see prices going up, people latching onto it, that often happens in equity markets. But in real estate, for example, if you looked at the last cycle, the underpinnings of that cycle was really affordability, right? I mean, you could see that, rental yields were really, when you compared the EMI versus rental yields, it was a very favorable equation. So a lot of people could migrate to start buying houses. And you don't see those conditions right now. I mean, if you look at least the major cities, that we are nowhere close to a situation where you can equate an EMI versus the rental yields and make a very strong case for house demand. And that's where my question really is. I mean, we don't have the conditions that, created that large surge in demand in the past. Will it really be different this time?
I'm surprised.
And even in terms of interest rates, you need to see a sharp deceleration in interest rates for that equation to really change if you're looking at the leveraged asset versus, versus your return profile.
So great questions, all of them. Let me unpack it into, again, several parts. So the first is, let's start with the last point, right? So we get out of the way. So interest rates, definitely, I think at the bottom, mortgage rates had gone down to 6.5%, some in 6.4 as well. And now they are up to, say, 8.5, right? In some cases, maybe even 9. But you know what? When I bought my house, 8%, 8.5% was a teaser rate. The standard rate used to be 10 to 12%. So I think the markets are used to and being very strong despite 10% plus mortgage rate. So I don't see this as necessarily a very major headwind. So 6.5 to 8.5 does look like rates have gone up, but in the overall context of where India used to be and mortgage affordability, I don't think 8.5 is that disruptive. Coming to the affordability, right? So remember that there are two types of home buyers. There are people who buy because they have new household formation, or they want to get closer to schools, or they think that a 2 BHK needs to become 3 BHK, or a 1 BHK needs to become 2 BHK. That transition, continues to happen. So household sizes get bigger. So versus the cohort that was buying houses in 2012, the cohort that is buying houses in 2024, those people have accumulated 10 years of savings. They have perhaps larger households. They have more responsibilities. Perhaps one of the parents needs to stay with them. And for 10 years, we've seen a downturn. So a lot of that demand is now ready. And so therefore, you look at price to income ratios. They are much, much lower than they were in 2012 because incomes have kept growing. So I'm not too worried about affordability at this stage, but that's exactly the point that we need to monitor, which is why I said in the answer to the previous question that we would rather we should allow for volumes to come up because if prices start going up, the cycle ends very quickly, and it's in everyone's interest that we get more quality housing at affordable prices. So I don't think, and rents actually are now starting to move up. In cities like Mumbai, Bangalore, rents, in fact, I follow the Twitter feeds, rents, at least last year, were rising massively in Bangalore. Right. I think that there are underpinnings. This is not castles in the air. There are solid reasons why this cycle can sustain.
Sure. Stepping back into macros, what kind of probability do you attach to US slipping into a recession? Because if you look at the stock markets, it's almost like they are discounting. I mean, there is no recession. We've thought about a recession in the last 2 years. It didn't happen, and now people want to believe that it's never going to happen. What's your take?
Yeah. So, people want like continuous entertainment in a way, so if it didn't happen last year, then it won't happen this year as well. Yeah. No, I think we have to understand why did the recession not happen last year? And in order to understand that, we need to look at what US policy has been. As you know, macroeconomic policy, there are two big levers that policymakers can use. One is the fiscal lever, and the second is the monetary lever. So fiscal lever is basically you borrow from the future, right? So the government issues a lot of debt. So collectively, taxpayers are responsible. You are borrowing growth from the future. The second is the monetary lever, where you reduce interest rates. You allow people to start borrowing from the future, and then therefore sort of support growth. After the 2009 crisis, the US policymakers decided to do monetary easing and fiscal tightening. So what because they had spent a lot of money recapitalizing the financial firms, and their deficits had gone up a lot. They said, look, we need to bring this down. And because the economy still has a lot of scars, and as we had discussed right at the front of this discussion, that, if you have a down cycle in real estate, that will take a while to run through. So then how do you support the rest of the economy? They said, let's do monetary easing. And that's why they came up with new tools, quantitative easing, printing a lot of money. That didn't work. And in fact, that's one of the remarkable strengths of the US, that they are very pragmatic about their policy making. There's no dogma there. And so what they did in this cycle, or after the COVID recession, is that they flipped it. So now they're doing fiscal easing and monetary tightening. So they've raised interest rates, they're doing quantitative tightening, and on the other hand, they are increasing the fiscal deficit. Now, consensus believed, and it did seem like it till the middle of 2022, that the US government was going to do fiscal tightening. consolidated fiscally as well. So they had bumped up fiscal deficits and they were trying to bring it down. But around that time, I think the government lost control. And I see that, and say that deliberately, it's a strong statement. I think their projections of income tax collection just went wrong. And what ended up happening is that in FY23, so their fiscal year ends in September. So FY22 fiscal deficit was $1 trillion. And I'm making an adjustment for something called educational loans waiver that had happened. So the accounting, it's an accounting entry. They first booked it as an expense because they do accrual accounting, unlike in India where we do cash accounting. So even though it was to be paid off over many years, they booked it in the first year itself. And because of a Supreme Court decision, it was reversed in FY23. So anyway, so once you adjust for this, the fiscal deficit went from $1 trillion in FY22 to $2 trillion in FY23. So there was a 3.7% of GDP increase in the fiscal deficit. If your fiscal deficit expands at by that magnitude, how can you have a recession?
Right.
And this is continuing. So what is happening now is that in the first 3 months of this fiscal year, so October, November, December, their fiscal deficits are up 18% year on year. And it is very likely that FY24 fiscal deficit will be 8.5 to 9% of GDP. Now, this is very dangerous. What this means is that their debt to GDP is now steadily moving towards unsustainability. And the reason why this has not yet shown up in bond yields, you would expect that the US government is doing so much of fiscal spending, then clearly, the yields on those bonds need to go up. And last year, it is shocking that 79% of incremental funding came through T-bills, like less than 1 year duration. With all the excess money that the Fed had printed, which was sitting in deposits at, 0.1% or 0% interest, were moving into money market mutual funds, and they started gobbling that up. Imagine the largest debt issuer in the world is funding itself through less than 1 year paper, short-term paper. This is very dangerous because at some point, and this is the note that we wrote yesterday, they will have to move into longer duration issuance. And the moment that happens, the 10-year bond yields start going up. And the 10-year bond yields start going up because of fiscal reasons. See, right now, 5% yield went to 4%. Like you mentioned that, the Fed is going to cut rates and therefore let's bring down, and therefore the markets are now rallying.
Yeah.
But imagine if that goes up to 4.5% or 5%, and the kind of stress it can create for cost of capital for the rest of the world, because that is the benchmark rate for risk-free rates. So I think the markets are celebrating prematurely for soft landing because it is being supported by what I think is unsustainable fiscal spending. Whether this happens and this correction happens in the next 6 to 9 months or not is the bigger question. I think there is a reasonable likelihood that it can happen. But even if it doesn't happen in the next 6 to 9 months, I think it is inevitable. It has to happen.
Right. So you do you believe in terms of policy, the Fed will actually start cutting rates sometime this year?
Yes, I think so. Given that their mandate is to balance unemployment and inflation, and if the level of fiscal injection is much smaller this year than it was last year, so it's like you take a guinea pig and you give it a growth boosting injection, which is the fiscal stimulus, and you also give it a growth reduction injection, which is the monetary tightening. And in the next year, the growth boosting injection is a lot feebler. Instead of adding fiscal deficit of 4%, you're adding only 1%. Then the growth numbers will slow down. And so even if inflation stays, so it did surprise last night on the upside, but even if it stays at 3.5%, 4%, the fact is that if the GDP growth starts to slow, then the Fed should be cutting rates. And I think they will. So they have signaled 3. Markets had extrapolated it to 6. Now I think the markets are down to 5. My sense is that 2 to 3 is definitely there is scope for that. But the extrapolation of that into the 10-year bond yields is where I disagree with the market.
Sure. So in terms of overall liquidity, what does this mean, Neelkanth? I mean, one thing is the rates, but in terms of overall global liquidity, where do you see that?
That's a great question. I think it's one of the most important questions because see, if you look at dollar liquidity, see, for whether we like it or not, I mean, there are people who are saying, why should the dollar be the reserve currency? Guess what? No one really has an option, right? I mean, it will remain a reserve currency till an alternative comes. Now, the quantity of dollars in the system is being reduced, right? So there is quantitative tightening. So the Fed is reducing its balance sheet, shrinking its balance sheet. On top of that, credit growth. So as you know, money is created either by the central bank or by the commercial banks. When they issue loans, they create money. Now, given the higher interest rates, the credit growth, the banking system credit growth is also slowing. So the money supply in the economy, or the money supply in the global economy in terms of dollars, is actually shrinking at 3 to 4% a year. And on the other hand, the US economy, because of fiscal spending, is continuing to grow. So as a growing economy, it needs more and more dollars. So it's almost as if, there's a body of water and you put a strong moon here, which is the fiscal spending by the US government. And so then water is getting sucked out. There's low tide showing up progressively. And I think liquidity will continue to get tighter till the time that the Fed realizes that, or I'm sure they realize it even now, but they realize that they now need to intervene. So they will have to start curtailing quantitative tightening and then progressively start doing quantitative easing. Because see, if your central government is going to be issuing $2.3, $2.4 trillion of debt every year, who's going to buy it? And if there are no buyers for it, then the Fed has to come and buy it, because otherwise it's just too dangerous for everyone in the world. So, but till that happens, I think the availability of dollars, the availability of liquidity in the rest of the world will remain an issue. Now, this is kind of contrary to what has happened over in the month of December. So, as the Fed signaled that they were kind of pivoting, and the market extrapolated it to 6 cuts in 2024, the liquidity that was available to emerging markets suddenly improved, right? Because see, there are always people who are seeing that emerging markets haven't seen good inflows for a long time, and they start extrapolating. So if the US Treasury yield has fallen from 5 to 4 or to 3.8, and potentially it can, they were extrapolating, it can go to 3.5 or 3, then suddenly emerging market assets become very attractive.
Correct.
So perceived liquidity will go through ebbs and flows, but the trend line will be down till the time that the US Fed curtails QT and starts doing QE again.
Okay. So the gist of what you are saying, I mean, if we take a 1-year period or a 2-year period, what you are saying is, well, the market is right now focused on rates per se and, rate cuts, because that has been the biggest driver over the last, 2 years. The bigger risk could be liquidity itself shrinking in the system. Is that the big risk for emerging market asset prices?
That and the fact that and so the effective liquidity will be affected by, because the US federal government is the first feeder in the system. So if you have, say, 10 chapatis or 10 rotis, and there are 5 eaters or 4 eaters, the first feeder doesn't have to worry about it, right? Because the US federal government's borrowing is the safest type of borrowing, and therefore supplemental lending. So therefore, they get to feed first. It's the last eater which then gets affected by this. So it's not just that there is liquidity tightening by the central bank in the US. It is also that the demand for that liquidity is going up significantly because of what the US fiscal deficit is at. And therefore, that's the dynamic that we need to be very careful about. And it will not just be the quantity of money. I think the cost of money is also, some people think the two are related, perhaps they are, but these are important variables to track, that the cost of money, the risk-free rate that all of us use to value financial assets in the next 5 years is going to be higher than what we were used to in the pre-COVID decade.
So the narrative will now shift gears from interest rates to fiscal deficit across the globe.
It should. It should. I'm surprised.
And that will be the bigger driver in terms of how the economic growth pans out for various countries, earnings growth, and so on.
Absolutely. And I'm surprised that this is not getting as much media coverage as it deserves to. Now, I'm starting to see some columns appearing in some of the leading financial papers in the West. But, this exorbitant privilege that the US has had, that any quantum of fiscal deficit that they have can get funded, is something that has made the mass commentary even not even look at it, right? So we seem to be the only ones looking at the fact that, 8th of the month, the fiscal data comes, can be tracked. We looked at it and we were shocked that, October, November, the deficits were up 14%. October, November, December, the deficits are up 18% year on year.
Right.
Now, why isn't there more direct commentary and aren't people? So I think over the next 6-9 months, as people become aware that this level of bond issuance is now happening, I'm sure this will become headlines making for the global financial markets.
Fair enough. And what does this mean for India, Neelkanth? Because we are in a unique situation, especially because of our inclusion in the JP Morgan bond index. So a lot of passive money has no way but to come here. So we can count on that $22 billion. And now there is talk of, India getting into the Bloomberg index and the FTSE index. So that might throw in some more passive funds also. So on balance, what do you see in terms of capital inflows into India? What does that mean for the rupee?
So, pre-COVID, the annual flows into India used to be, they tend to be very volatile. Capital flows are always volatile. But if you were to do a trend line, say a 3-year moving average or something, you would notice that we could have funded a current account deficit of $75 to $80 billion. In the current environment, I would think that anything above $40-45 billion would be very hard to fund, because what you are seeing is that net FDI is shrinking, has shrunk. External commercial borrowings can potentially go negative, because it's not just that you are unable to sort of get dollar funding as a company. The dollar loans that you have, as they mature, you may struggle to roll them over. So you may actually repay the dollar loans and borrow them in India. Trade finance, so as the interest rate environment in dollar terms remains elevated, capital flows, especially to emerging markets, can remain constrained. India is, as you rightly said, in a slightly more privileged position. Not only is it the fastest growing among the fastest growing large economies. It is also because of the bond index inclusion and the fact that the government and the RBI have prioritized macroeconomic stability, and that's been the remarkable achievement for the country, that investors have demanded that India be included in the index. So till say 3-4 years back, it was Indian regulators figuring out how to get India included in the bond index, and they did a lot of work. But the final inclusion has happened because the investors demanded, well, we want to buy Indian bonds, and why don't you include it as part of the index? So we are in a somewhat fortunate position that our balance of payments can still remain supported. But the index inclusion can be a one-time flow. It'll run through 10 months, so it'll be long enough for the markets to feel secure about it. But it cannot be forever, in the sense that you cannot extrapolate that extra $20-25 billion that you get will keep coming in every year.
Right.
But I think from the rupee perspective, to answer that specific question, my sense is that if you are looking at the USD INR, we should continue to expect low volatility. We flagged in our outlook note for 2024 that in 2023, the rupee was the least volatile currency in the world. It was actually less volatile than even the Chinese renminbi. And I think the RBI has the ammunition to dampen volatility on both sides. But if we were modeling USD INR, I would think that there would still be marginal depreciation.
Marginal depreciation. Okay. So that's what I was about to ask, that, will that the equation that the foreign investors really look at, which is, a 4% kind of depreciation in INR every year, and juxtapose it against the US rates, does that equation really get altered, and can we count on some steady capital flows, especially into equity markets, once this one-time bounty that we will get over?
So there are many uncertainties right now, and given the fact that the US debt to GDP seems unsustainable, at some point people will start wondering if the only solution to making that debt sustainable is financial repression, that you have negative real rates in the US because of what the Fed is going to do. Then you might as well be in a country or a currency where that's not happening, and which is India. And those things will happen eventually. But the rate differential versus currency exchange rates is something that perhaps works in countries or economies with open capital accounts. In India's case, this is not the case, and therefore the USD INR moves broadly under that control, or the volatility is controlled by the central bank. So we should expect that there still will maybe mild depreciation, though beyond, say, 12 months, how the US policymakers respond to this growing debt to GDP once the elections are over in the US as well is going to be very critical to where the USD INR finally lands up. But for the next 12 months, I think it is reasonable to assume that in case we start to get a lot of inflows, the RBI will build reserves and keep pushing the rupee down by maybe 1 or 2%. 4% a year is too much. I don't think we should that should be the expectation.
Sure. And for this year itself, I mean, what is your expectation in terms of equity flows? Because the market seems to be counting on the fact that if there are, if the Fed cuts rates twice, there will be naturally huge amount of flows that will come back into equity markets. Is that something we can take for granted?
No, I don't think we should. I think that's just hope parading as forecast. So I don't think, and courtesy the background to this is all the things we've discussed earlier in this chat, that I think dollar liquidity will be an issue. I think the pension funds and asset allocators will start questioning if we are getting 4.5% rates on US treasuries, why are we in any of the emerging markets? And EM funds are seeing outflows, even though India may be, and it will be, I think, doing very well economically. The fact is that a lot of the flows that come to India come through Asia funds, EM funds, global funds. And if those funds are seeing challenges, either it is because of China or some other emerging market that gets into stress, I think the flows to India will be affected. So I would not extrapolate the flows that happened in the month of December, which was, I think, a bit of a surprise. It came because the Fed's pivot turned out to be surprising to people, and that triggered some new flows. But I think it would be a mistake to extrapolate it over 12 months. Sure.
Now, in terms of valuations, I read in your note that, one of the things that the market is ignoring is the fact that, P's, although are pretty much in line with the last 10-year average, they need to be looked at differently, or they need to be reevaluated in the context of the fact that US risk-free is at a higher level today. And that's like a reset that most analysts don't talk about. Tell us about the risks emerging from there. Do you see that being relevant even for global investors? Of course, it's a very important metric, so it has to be relevant. But when you look at it, even from the standpoint of a domestic investor, should we be benchmarking it against US risk-free rates?
Again, a great question and a very important one. See, first is that the yield gap between the US 10-year and the Indian equities, if you measure earnings yield, right? So the reverse of price to earnings, is at the lowest level since January 2008. So investors of a certain vintage, there would be a shiver down their spine, right? So on a relative basis, Indian equities are perhaps as expensive against the US 10-year yield as they've ever been. And the way to adjust for that, or the way this can correct, is that the US 10-year yields were to fall substantially from here. And if they go back to 2.5%, 3%, then you can say that, yes, it corrected. Now there is a yield gap because, if there's a risk-free rate and then you're adding on country risk and asset class risk, like, equities, you still get there. So there is that distortion. Even today, foreign funds own about 18% of the BSE 500, and they account for about 35% of the free float. So we cannot take them trivially, because this is why you're actually seeing that there seems to be some valuation discipline in the large caps, but in the small caps and mid caps in India, I think there is a lot of froth that is now becoming visible. And the question is, should we, if most of the domestic inflows, say $30-35 billion, are almost structurally coming into Indian equities every year, then should we even bother about what the foreigners are doing? At this point, I will flag that even if you did the discount rates on Indian equities and you use the Indian GSEC yield, the government bond yield, 10-year bond yield, as the discount rate, you would find that the equity risk premium is too low. For a while, it was actually negative. So even compared to Indian government bonds, Indian equities are expensive. Now, this correction in PE multiples is not going to happen suddenly, because it is about the market as a whole. The market has millions of nodes, basically millions of people, millions of entities which are trading and dynamically pricing in assets. So as that happens, I think the collective appreciation of the change environment is something that takes a while, and it could take several years. But it is prudent that if we are thinking about an exit from a stock or say from even the Nifty, say 3 to 5 years from now, we should be modeling in lower rates. So these things don't change very quickly. This takes 3-5 years. But when the rate situation globally seems as inevitable as it does right now, I think it is prudent to be a bit cautious. And if you're in the small and mid caps, you need to be very, very even more cautious, because while in large caps there seems to be no froth, in the small and mid caps, several of the warning signals are now becoming visible. So I heard the other day that there's some trading house which has set up a 2,000 member options writing desk in Bareilly. There's nothing wrong with Bareilly. What I'm saying is that those size of desks and the kind of options trading and that kind of fraud, which is very important part of market expansion, but when it happens as rapidly as it has, it gives you a signal that things are starting to go out of hand.
Sure. And one last question. So this value trade, the way it has emerged, one of the reasons perhaps this value trade is playing out so well is also because of this dynamic of interest rates, etc. Do you see this continuing, and do you see a moderation in PEs of consumer companies and a whole bunch of companies which did remarkably well in the absence of growth in the core industries since 2014 or so? So in some sense, the valuation discrepancy between these two sets, the core industries, industrial, etc., at one end, and the consumer companies on the other end, does that kind of get evened out as we go on?
Yeah. So what we have become used to, or what we use, is what we call the Z score, in the sense that the number of standard deviations above or below the 10-year average for the sector. Right? So if the 10-year average PE for the sector is say 20 and the standard deviation is 2, then if the sector is trading at 22, we say it's +1 Z score, and if it is at 18, it will be -1 Z score. On this measure, the industrials are at 2.5 standard deviations above their 10-year moving average. Now, you can say that last 10 years were disastrous for them anyway, so why are you using that metric? But as I mentioned earlier, these changes don't happen very suddenly. So there are anchors, there are biases, and I think that sector is already pricing in quite a bit of growth. In fact, we are underweight that sector. We find that a better way to position for a phase where gross fixed capital formation, or the proxy for investment in GDP, is going to be higher than average GDP. So basically, investment share of GDP is going to go up, is by buying financials and construction proxies. And in this case, I mean, currently also maybe even utilities, because we are starting to run out of power capacity.
Sure. So your top 3 bets would be financials, utilities, and
cement.
And cement. All right. On that note, Neelkanth, thank you so much. It was a pleasure talking to you as usual. Great insights. Thank you so much.
Thank you for having me on the show. Great catching.